Hello, Matthew Bell with InsurancePrescription.com, and today I wanted to talk a little bit about money laundering. Now, in general, the reason I'm tackling this topic is because it was one of those things that I was always curious about, things that I would hear about and didn't really understand what money laundering was. So I'm just going to kind of sketch it. It also bears on some of the things that I've talked about in other videos because money launderers apparently have sometimes avail themselves of insurance policies, cash value insurance policies, in order to accomplish their money laundering goals. So let's get into it. So in general, money laundering is where you conceal the origin of funds in order to make them appear to have been obtained legitimately. So for instance, if a person is involved in some illegal operation, it could be drugs, it could be terrorism, it could be counterfeiting, theft, whatever it is, illegal gambling, illegal prostitution, right? The money they obtain from those operations, they want to be able to spend, but they can't just deposit them directly, or the IRS or the banking institution is going to raise questions about what their source of that income is. So money laundering is essentially the process of taking funds that were obtained illegally and obscuring that illegal origin so that the money can then be used. Anti-money laundering, then, is obviously an attempt by government and other agencies to counteract money laundering. And part of that counteraction is going to be to prevent it, to detect it when it's going on, to try to make it more difficult to accomplish, to punish those who have done it, and the like of that. So there are a number of laws that actually pertain to money laundering. I'll just run through a few of them here. The first is the Bank Secrecy Act of 1970. Then there's the Money Laundering Control Act of 1986. The Anti-Drug Abuse Act of 1988 also has references to money laundering, and this again is one of those areas where there can be cross-pollination of different kinds of illegal activity. In 1992, there was the Annunzio-Wylie Money Laundering Act. Money Laundering Suppression Act, that was in 1994. 1998 had the Money Laundering and Financial Crimes Strategy Act. One of the big ones was the USA Patriot Act in 2001, following the terrorist activities of 9/11, essentially, and part of the investigations that have developed from that terrorist event led investigators to the conclusion that certain operations were carried out because of laundered funds. Terrorists often will avail themselves of this kind of strategy. In 2004, there was the Intelligence Reform and Terrorism Prevention Act, which again made reference to money laundering activities. And finally, in Title 18 of the United States Code, in Section 1956, there is an entire presentation on money laundering. Once again, money laundering is going to dovetail with other kinds of criminal activities, from theft, prostitution, terrorism, illegal gambling, tax evasion, and other kinds of activities are also going to dovetail. It's not uncommon to see laws that pertain to some other criminal activity also have something relevant to say on money laundering. Now, it turns out that there are a couple of businesses that are favored by money launderers in order to accomplish their ends. So a couple of these are going to be, mostly these are going to be cash-heavy businesses. So we're talking about things like coin-operated laundromats, car washes, bars, nightclubs, restaurants, striptease joints, gentlemen clubs, casinos. There's three phases of money laundering. The first is called placement. So remember, the money launderer's objective is to take money that has been obtained illegally and to use it, basically, without having to own up to the illegal nature of where that money was obtained. So the first step is placement. That is to say, sticking it into a financial institution so that the remainder of the process can unfold. So placement essentially is where the money is deposited somewhere. Usually this is going to be in some legitimate financial institution like a bank, a savings and loan, credit bureau, whatever it is. But it could also be through the purchase of some kind of an asset like life insurance policy, a vehicle, a home, a business, something. Now, in general, smaller deposits are preferred over larger ones because they don't want to draw attention to the money. So if somebody just walked into a bank and opened up a savings account with $1 million, not a few eyebrows would be raised over that. So in that case, the deposits may be a series of small deposits. Now, there are certain thresholds, whether it's 5,000 or 10,000, that will initiate or instigate flagging at various institutions. So for instance, banks will often flag deposits that are over $1,000, cash deposits. If they're over 1,000, they have to file a report and send it in to the various government bodies that monitor this kind of thing. But in general, the idea is to move the money from illegally gotten sources into a legitimate financial institution and then to be able to use it down the road. Now, the process of breaking that sum of money into smaller pieces is basically called structuring. So structuring occurs where instead of taking $100,000, you make 10 deposits of $10,000 each. Now, again, at that threshold, there would be some kind of a flag probably, but you get the picture. Now, the second stage of money laundering is essentially called layering. Now, layering occurs when the criminal is going to string together transactions in such a way as to obscure the origin of these. Now, there's a number of different analogies here. In one source that I consulted, the analogy was basically like you're trying to evade somebody who's following you. And so you cross the street at random times and you double back and you take, you go in through the entrance of a business and go out the back door. You're trying to lose a person who's following you. That's the idea here, is the transactions are strung together in such a way as to try to prevent a person from easily following where the money came from and where it's going. Another analogy might be in older times when phone calls were traced, apparently using technology that kind of reconstructed all the switches that would handle the routing. Phone calls could be made more difficult to trace by just simply switching them many, many times. So you might send the call from Chicago to India, and then from India to Russia, and Russia to China, and China to Italy, and Italy to New York, and then to the destination, let's say Washington, D.C. So essentially it's a call from Chicago to Washington, D.C., but because it's been bounced through all of these different foreign telecommunications centers, it makes the call more difficult to trace. So this is just an analogy. Most of the time, sophisticated money launderers are going to do a little bit more than just deposit the money in institution number one, transfer the funds from institution one to institution two, and then withdraw the funds. That is easily traced. So what they're going to do is they're going to layer. They're going to essentially try to obscure the origin of the money by moving it, almost like a shell game where you watch these people take a little ball and hide it underneath various different cups and then shuffle it around. It's the number of motions that makes that hard to follow. If you just set the ball under a cup and moved it a couple of times and then lifted the cup, it wouldn't be difficult to discover what happened to the ball. Now, the third and final phase of money laundering is called integration. And in integration, it's kind of just like what it sounds like. When you integrate something, you bring it into the fold. And so the idea here is, with placement, you took illegal funds and put them into an institution. With layering, you try to, like a shell game, obscure the origin of those funds. And with integration, you then want to pull the money back out so that you can use it. Obviously, these criminals want to use the money for some kind of a purpose. They want to use it to spend for groceries and bills that they have and for the legitimate and normal necessities of life, luxuries or whatever. And so they want to get their funds back out. So essentially, integration is where these laundered funds are then brought back into the mainstream, where they're brought back into the fold and they can be spent in the normal economy. Now, there is an illustration, one of the most famous instances of money laundering on record, and I may do just an entire video presentation just on this, but the guy's name was Eddie Antar, and he ran a electronics store called Crazy Eddie's Electronics. It was a money laundering operation. So he turned this electronics outlet into a money laundering operation. But then he even did more than that. He was able to artificially inflate the price of the Crazy Eddie Electronics stock by dumping these illegal funds in. And so not only did he have an illegal money laundering operation, but he also had illegal manipulations and securities violations, essentially, that would be investigated by the Securities and Exchange Commission, or the SEC. So he also committed stock fraud, basically, on top of the other crimes that he was guilty of. But why my interest? Well, once again, this is a topic that does filter and percolate down into even the level of the insurance industry, because cash value insurance is one of those vehicles that if somebody were to come in, they can put their money into a cash value life insurance policy and then, could cash it out, and it would appear as though they were just cashing out money in a life insurance policy. So money laundering has become a severe problem. And in some areas of the world, it's going to be worse than others. So, for example, in the Midwest in the United States, it might not be a huge issue, but in the area that's right along the Mexico-United States border, maybe it's a little bit more of an issue because of people possibly running drugs or other illegal operations. Then, of course, you have offshore companies that may be laundering money for any number of activities, drug running, again, prostitution and sex slavery and that kind of thing. So there's any number of different things that might be implicated in this. But again, I just thought I would kind of talk through it. Every year, people in financial industry have to kind of go through training on money laundering, and I just thought I would kind of talk through some of the relevant issues. If you found something of interest in this video, please like it, please subscribe to the channel. I do have other more straightforward and applicable content to retirement and other kinds of planning scenarios. This was just kind of off the cuff here, but if you did enjoy it, please like it and click the notification bell to be alerted to future content when it becomes available. I thank you so much for joining me today, and I look forward to seeing you again in another video. Thank you.